Welcome all to Equity Learning Module 5, Company Analysis, Past and Present. Great news. The last three modules here are just going to apply everything that you already know. So there's very little in here, if anything, that you won't have seen elsewhere in the equity or the corporate issuers or the FSA or even the economics section. We're bringing all of that together to say, look, in your role as an analyst, let's put together a research report using all of the skills you've gathered from elsewhere. So this is the fun stuff. Let's begin. First, LOS. Describe the elements that should be covered in a thorough company research report. And what we'll actually do just to start off this LOS, because it's not great, it is just a list. But what we can use it for is really just to summarize the three modules I just talked about and everything we're going to go through. So we're starting here at the bottom of this company and industry analysis framework triangle, if I can call it that. At the bottom here in company analysis past and present, this is our current learning module. So this is what we're going to do. List out what's in there. Okay, a little bit tedious, but then we get into the good stuff with LOSs B, C, D, and E. We're going to determine the business model, analyze revenue and revenue drivers. You're going to see the word drivers throughout these three modules. Operating profitability, working capital, and then capital investments and capital structure, uses of capital and sources of financing. And that should give you some confidence that I wasn't lying, that everything that we're going to see in these modules you've seen already. FSA, we've talked about revenue and how to record revenue. We'll talk about what drives it now, either from within the company or given the market structure. Market structures were in economics. We'll analyze operating profitability. To do that, we'll need ratios. Well, from FSA, we've got our operating margins. We've got our return on equity, return on invested capital, and so on. We'll analyze working capital. Days of inventory on hand, days of sales outstanding, payables days, cash conversion cycle. We've seen it all. We'll analyze capital investments and capital structure. In capital issues, you've talked about leverage, debt versus equity. Then we're going to move on, not right here, obviously, but in the next video, we'll go on to LM6, industry and competitive analysis. Once we feel at the end of this module that we've got a handle on our company, how it operates, what drives its revenues, what its business model is, we'll then look at the industry that it sits within and decide what's attractive or unattractive, what's constraining about that industry. Once we have that, LM7, we'll try and put a forecast together. If we know what this company's business model is, what drives its revenues and its operating profitability, how its capital is raised, and we know the industry it sits in, we can now start to forecast into the future its revenues, its profits, and its position, and along with that, evaluate key risks that it faces. Once we've done that, in reality, we would then go on and do a valuation. And that is your final learning module. To be fair, there is new material in there. So we've got three in a row here. Once you put all those together, you'll go on and learn how we use our forecasts. Once we know what dividends are going to be, or revenues are going to be, or free cash flows are going to be, we can use them to do valuation. So that kind of frames it all, shows you where we are, what we're going to do in this module. As I say, we're really looking internally here before the next module looks at the market, and then we make a forecast. So let's get into it. I said it was going to be fun. This first LOS is not that much fun. It's really practical in nature. In terms of exam questions, I don't really think the examiner is going to enjoy asking you to try and remember a list. It is clearly up to you to a certain extent as an analyst how you present your report, but this is just a typical set of information that will go in there. And once again, we can tie it into what we're going to study. You'll start off with some basic info. Fine, I'm not really too excited about that. But really, we're coming from the angle here of a sell-side analyst. We are putting research out there with a recommendation attached. That's the big headline item here. What's your recommendation? Buy, hold, or sell? Maybe you're giving a target buy or a target sell price. That should be up front, and all your disclosures and disclaimers, fine. Then a little bit of detail on the recommendation and the key reasons why you've made that recommendation. That's really your executive summary, if you like, in old school language. Then we'll get into the detail and look at this. The first section is a company description. It discusses the issuer's business model and strategy. That's us right here in this learning module once again. Then the next learning module, industry and overview and competitive positioning. We know our company. Now let's take a look at the industry. Then the next learning module, let's analyze and put together a model so we can make forecasts. And then the final learning module. Once we have our forecasts, let's use them to come up with a valuation, which will obviously drive our recommendation, and the summary of the key reasons will be based around these forecasts and valuation models. Obviously, in this day and age, we're going to put some ESG material in there. We covered that in corporate issues, issuers even, and then some risks at the end. So not too thrilling. That's your initial report. So we're assuming here you're a sell-side analyst. You've never looked at the company before. This is your first report that's going out. That's everything that should be in there. But on an ongoing basis, you are going to issue subsequent reports. Things change. So you'll have to keep your recommendation, your research, and your forecasts current, up to date. Once again, you'll start off with some dull stuff. Then the key point, your recommendation, targets, buy, hold, sell, etc. A little bit about your recommendation. And then because this is a subsequent report, analysis of new information. If the quarterlies have come out, the annuals have come out, you'll interpret this new information and explain how and why it has changed or not changed your recommendation. Still, you'll have your section in there on the valuation risks. Obviously, this valuation will update for the update in your forecasts given that new information. So just lists of what should go in there to give you an idea of the structure. Not that exciting. It gets exciting from here on in. With LOSB, determine a company's business model. Step one of putting together our research report. Understand the company and what drives A, its revenue, and B, its profitability. There you go. Step one, as I say, of the framework, identify the business model. And not that this is particularly in this reading, so I'm not saying, oh, you need to know this for this learning module. But one thing that always pops into my mind when I think of the business model is DuPont. Just on a very basic level, if I can think DuPont, remember if we break DuPont down into the basic version, we can break down a company's ROE into its net margin multiplied by its asset turnover multiplied by its financial leverage. So how many dollars of profit do you make per dollar of revenue, your profitability? How many dollars of revenue do you generate with your asset base, your efficiency, how efficiently you're using your assets, and your capital structure, how much debt do you use, how much leverage is there? And firms, different firms in different industries with different business models can all get back to the same exact ROE with different combinations of these three. You could have a very low margin, but a high asset turnover. You could have a very high margin, a very low asset turnover. And in either of those situations, you could ratchet up your return on equity by using leverage, by funding your assets with more debt. As I say, that's back in the world of financial statement analysis, but it's something I think is useful just to have in your head when you're looking at a business model. What does this business model do, or what should it do for us as an analyst once we've identified it? Well, it gives you the key drivers. I said you were going to see that word a lot, and it's key for you as an analyst. You're not just looking at output and stating facts. If that's all you do as an analyst, you are going to be replaced by AI very easily. Not even AI, just Excel. Excel and web scraping programs can pull down information, calculate a ratio, and present it. Your job to add value as an analyst is obviously to forecast and come up with these valuations. That's the real difficulty. But before you do that, it's to get the fundamentals right, to know what you should be looking at to drive that forecast. What are the key things that affect this business? So we're looking to identify the key drivers of your financial results and your position. That will tell you as an analyst the key areas that require further investigation. This fact here drives everything. This is key to their performance. That will allow you to set expectations. Know what you're looking for. That's what the business model should do. If I'm looking at, which we're about to do, if I'm looking at a retailer who aims to pile high and sell cheap, then my expectation is to see a fairly slim margin. They're not going to make a big, hefty net margin, but I would expect them to have an impressive asset turnover. If you're operating with razor-thin margins, you have to operate efficiently. So what requires further investigation from me? I'm not going to get overly excited about those margins. I know why they're doing it. I'm not panicking that their margins are tight. But what I will look at is how efficiently they operate. Because with that narrow a margin, if you're not efficiently using your assets, you are not going to make a positive return on equity. So that's what I'll focus on. Key elements. The products and services you deliver. Obviously, we need to know what they are. The key customers and customer groups. Are there any key customers and customer groups? If there are, if you have one or two huge customers, that could have a big impact on your pricing power. That really comes in the next learning module. Sales channels, how do you deliver your goods? Is it physical? Is it online? Is it immediate? Is it bespoke? Does it take 15 years? If you think about distilleries, it may well take 15 years to deliver it. Customer acquisition, how do you go out and get your customers? Is it word of mouth? Do you engage in heavy marketing? Are they delivered to you by complementary businesses? Delivery mechanisms, how does the product get from you to your customer? That could be a key driver of profitability, especially if you're in an inflationary environment. If fuel prices are rising, suddenly transportation becomes huge. So you have a big advantage if you can avoid transportation costs or pass them on to a third party. Price and payment structures. Price is dictated to a certain extent by your pricing power, which will be dictated by the industry that you're in, its level of competition. Much more on that in the next learning module. And payment structure, how do you get the cash in? Because that is going to have a big impact on your working capital requirements. Do you get the cash in from your customers quickly? If you're retail, do you get the cash at the point of sale? If you're bespoke, do you build the entire product first? Are you building a custom yacht, which may take you 18 months, in which case, when do you get the cash? Do you have to fund that build before the cash comes in? That gives you a big working capital problem, potentially. Resource and supplier relationships. Do you rely on key suppliers and key resources? Once again, if I'm at a razor-thin margin and I need to operate efficiently, my suppliers could be absolutely key in making sure my operations remain efficient. I might be trying to pass costs on or pass costs back to those suppliers by making them hold the inventory until I need it. Information sources, not that much to say. The issuer themselves, the 10K, the annual report, the quarterlies, all sorts of other documents they have to produce and file in the US with the SEC. Talked about that back in financial statement analysis. Public third party, get on the web, obviously. Proprietary third party, FactSet, Bloomberg, etc. Or proprietary primary research. Commission some research. ask somebody to look into it. If you're looking at retail, then pay an analyst to go away and come back with a 50-page tome on the retail market in the US or wherever you may be. So lots of sources that you can use, not too exciting. This is what we're focusing on. We need to know, what is the firm's business model? That involves answering all of these key questions. And the way we're going to do that in this module is via a case study. We're going to walk through a case study for a given fictional company and try and identify its business model by answering these questions here or addressing these key elements. Nothing new, as I say, the module is mostly one case study that they walk through. We'll just walk through it with them. That's why I say it's fun. Not that much new to learn, just good, honest fun trying to spot what, and the name of this fictitious company is Warehouse Club Inc., what Warehouse Club Inc.'s business model is. So here we go. Let's just read through it with these key elements in mind. I'm reading this report as an analyst trying to assess their business model. So what do we have? We've got Elaine, an analyst at Fileton Investments. To find investment candidates for one of the funds, she ran a screen for companies in developed markets, exceeded sales growth, and so on. Okay, this is all fine. One company that passed the screen is Warehouse Club Inc. So this is what we're going to walk through in the module. She hasn't heard of it, neither have her colleagues. So we're going to research it for a few days, see what happens. Now we get some information finally. Warehouse is a public company. Yay, that means we're going to have access to financial reports, financial statements, 10Ks, etc. We compile several issue information sources, annual report, transcript of management's presentation at a recent investor event. This is what we're looking at first. Following paragraphs are from these sources. Let's see if we can figure out the business model, set our expectations, get a picture of Warehouse Club Inc. Warehouse Club Inc., we, our, us, the company, is, here we go, a leading discount retailer. So straight away, and I mentioned this up front anyway, so this should not be a surprise. First of all, what they do, they are retail, so it's not really a service, it's a product. They're selling goods. And I know their pricing policy. It's to issue things, or sell things rather, at a discount. I'm setting my expectations for their margins, and I'm ready to not be disappointed by a low margin. But I'm hoping that they are efficient. They'll have to be. Consistently offering customers more than 20% savings on a broad range of food and other merchandise compared to supermarket, department store, convenience store, and e-commerce competitors. And e-commerce competitors tells me that they have physical locations. They are not an e-commerce company. Now, I'm sure, particularly post-pandemic, that they have channels for you to order online and pick up, but that suggests to me an e-commerce competitor, they don't sell exclusively online. Warehouse operated, here we go, 149, 145, 141 stores. Yep, physical locations. In 1918-17 respectively, so 1918, 1918, 17, so a number of stores are going up. We sell a core assortment of packaged food and beverages, so there's their retail, they're retailing food and beverages, and fresh food, and non-food, such as apparel, appliances, electronics, and entertainment, houseware, and sporting goods. So they are in retail, and they retail lots. Where was I up to? I think sporting goods. In addition to our core assortment, our stores feature a changing assortment of seasonal or discounted items. I can picture Warehouse Club now. This is when you walk in the day after Christmas and they have 3 aisles dedicated to Valentine's Day. Based on the latest consumer trends or the latest trends that we want consumers to be into, and availability from suppliers which vary by store. We also offer, so availability from suppliers which vary by store. So it sounds like they have relationships with suppliers whereby whatever's available and seems cheap at the time, they will take. So it'd be nice if they had a solid, tight relationship with suppliers where they could say, look, give us the nod. If you've got something that's in demand, you've got it in bulk, we'll take it. We also offer ancillary products and services such as petrol stations, okay, co-located within our stores. So That's interesting. People are now on your premises to get the discounted goods, and you sell them add-ons like petrol, gas, as you would call it in the US. Now, they're a discount store. They're trying to get you in. Now, maybe they offer, and certainly I've experienced this in the past with some of the large supermarkets in the UK, they'll try and get you there by offering you really cheap petrol, really cheap gas prices to get you on the premises. Let's read on. In-store takeaway pre-prepared foods, pharmacies, so they're selling you your drugs as well, and opticians, and hearing aids, everything. They want you when you go into, or when you go into their store, they want you to be able to see and hear everything perfectly and buy even more stuff. In addition to carrying the leading branded goods, we also sell packaged food and household goods under our own exclusive private label brand. Okay? That we source from contract manufacturers. So resource supply relationships, that is definitely an important one. They have contract manufacturers that make their own brand. So it's their own brand. They're certainly not making it. It accounts for over 15% of our net sales and have higher than average profitability. So they are key for their own brand. One of the most profitable lines they have, they need to maintain those relationships. We operate a member-based model. I'm thinking Costco here. Member-based model, but this is fictional, that requires customers to show their membership card to enter and shop in our store. So key customers and groups, let's be honest, this is retail. So people are walking in and buying stuff for their own household. So customers are definitely fragmented. There's no one huge customer group that can, hold them hostage and say, we demand prices drop, because there's so many different customers. But in terms of a group, I don't know if it fits into there in terms of the business model, but I just want to make a note that they sell via memberships. It's a membership-based model, so you're going to have to show a membership card to enter and shop in the store. So you can't go in unless you are a member. Annual membership fee is $60 per household. So products and services, I'm just going to make a note of it there. Now it's a fee. So we're going to move on and look at revenue drivers. One of them is going to be this membership fee, clearly. Estimate the members' annual savings versus shopping and competitors for the same basket of goods amounts to over 5 times their annual membership fee. Pricing is absolutely key. Why are people willing to pay $60 a year to shop here when you can go into other shops for free? The only reason you would do it is if you are making savings greater than that $60. Or at least, if it looks like you will. I think we've all done this where we join, pay the $60 and then never go again. It was a good idea at the time. But you have to have the perception that there are savings to be had. That makes their pricing structure, again, absolutely key. Let's move on. Membership fee revenues, left us hanging there, were 601, 576, and 553, so 987, so 789. They're rising, which is good news. Besides providing us with a source of recurring revenue, membership engenders shopper loyalty, drives our industry low levels of inventory theft. Nice, less than 20 basis points of percentage of net sales. That's good. Fifth of their competitors. That's just interesting kind of behavioral science, really, isn't it? If you've paid a membership fee, you don't steal as much. Anyway, that's a side quest. Total memberships were 10, 2, 9, 8, 9, 4, 8, 9, so 7, 8, 9, 7, 8, 9. So both income and memberships going up makes sense. Our strategy, here we are. Based on price and cost leadership. I think we kind of worked that out already, that we are a discount seller, but in terms of how we operate, what our model is cost leadership. That makes efficiency, as I keep saying, absolutely key, and these supplier relationships absolutely key. Stock a limited selection of high-quality branded and private label products in a wide range of categories that produce high sales volumes, there you go, and rapid inventory turnover. That's working capital stuff. That is efficiency. This is exactly what I was saying earlier on. Razor-thin margins, but high efficiency. We limit items to fast-selling models, sizes, colors, carrying an average of approximately 4,000 unique products per store, less than a quarter of the assortment of our supermarket and supercenter competitors. Efficiency, keeping down your working capital, keeping down your inventory costs. Most items sold only in bulk sizes. Wherever possible, we utilize direct from manufacturer distribution. Once again, supplier relationships is going to be key. And move merchandise immediately to the sales floor, presenting on pallets in a no-frills warehouse atmosphere. Brilliant. Our high-volume purchases of a limited number of products direct from manufacturer distribution, reduced handling of merchandise, enable us to hold a low-cost position. That's their business model. I think we've got it. In the retail industry, in terms of merchandise labor costs, our low costs and membership fee revenues enable us to operate profitably while charging significantly lower prices than other retailers. Margin is low, they top it up with membership fees. Low prices, quality products drive greater membership and net sales. Make sense? Leveraging our selling, general, and admin expenses, reducing them as a percentage of sales. We'll talk operating profitability in the next couple of LOSs. Our stores operate on a 7-day, 70-hour week. So that's not ridiculous. It's not these kind of 24-hour day things. Predictable shifts for employees. Bit of ESG here, because the hours of operation are shorter than other retailers, and due to other efficiencies inherent in a warehouse type operation, labor costs are lower relative to the volume of sales. We look to maintain a large base of full-time employees with above average wages, ESG, and benefits to establish long tenures, as we believe this maximizes productivity and customer service. I would agree. Our employee retention rate for employees who've been with us for at least a year is 90%. That's good stuff, which we believe is substantially higher than the retail industry average. I would agree. Certainly given my local grocery store and the staff that you see in there week to week. I'm not sure I recognize one that's been there for more than a month. Our retail operations, which represent substantially all our consolidated net sales, are our only reportable segment. So no issues really with kind of segmental analysis and product mix. I say product mix, they sell absolutely everything. So it would be nice to break down kind of food, non-food, appliances, petrol, etc. Don't have significant sales outside our domestic geography, the United States. So no global considerations. No single customer or supplier represents a material amount of revenues or merchandise costs, respectively. So that calms me down about supplier relationships a little bit. We're not dependent on any one. It is still key to make them efficient. So if I look at my key elements, I know what they sell, almost everything retail, and it's on a membership basis. Key customers and groups, well, we know it's a member-based model, so they have recurring revenue there, but there's no one customer that has power over them. Sales channels appears to be physical stores. I don't see any e-commerce angle. Customer acquisition, don't know anything about that yet, have to say from this statement. Don't know how they market. Delivery mechanisms, well, it's physical, right in the store. Price and payment structure, we know it's a discount model to get them in. The payment structure, my thing is point of sale. You go in as a customer and you buy your goods. That said, you are paying $60 up front for the year. Resource and supplier relationships, they are key. I'm going to stick to my guns on this. No one dominates, but to be efficient, they have to maintain those relationships. There you go. Now, in terms of that, what's examinable? This may be obvious. Apologies if it is obvious, but we get this question a lot. Is Warehouse Inc. examinable? No, this is just a walkthrough example case study. They're not going to test you on this case study. They're just trying to give you practice on how to read this information and answer those key element questions. What the module does after warehouse is give you another one very similar and say, okay, now you answer the questions. We won't do it for you. So highly recommend you walk through that. Next up, revenue. We have an idea of the business model. I won't say it again. I know I've said it enough, but we know where we're at now and what they're doing and how they're trying to generate a profit. Let's now look at where their revenue comes from and what their revenue drivers are, including their pricing power. And to set the scene for that, I'm just going to use another exhibit that they actually put into this module in the business model analysis. where Elaine was going through and trying to work out what they do. Just information about number of stores, number of members, and annual net sales. So if we're going to try and look at the drivers for revenue, we should at least know what revenue is. At the bottom of this left-hand exhibit, we have annual net sales in millions. From 2010, 2019, we can see a pretty solid trend, which is nice, up to 28,377 million. On the right, the breakdown. And this, I think, just raises a couple of interesting points. Net sales for the 3 years, 17, 18, and 19. You can see again, as we've already said, rising, which is nice. Look at net sales compared to membership fees. Net sales, the vast majority. In 2019, for example, sales were 98% with membership fees the other two, so only 2%. So you could be tempted to look at that and say, membership fees not that important. But look down here at the net income line. 598,627,662. Compare that to membership fees. 553, 598, 576 to 627, 601 to 662. Pretty similar to your net income. I'm not saying that's a good thing, a bad thing. I just think it's kind of interesting. What you'd obviously have to do before you say, well, they would make zero profit if they didn't charge a membership fee. You've got to try and allocate a proportion of operating costs to generating those fees. So it's a bit more complicated than that, but it's, if nothing else, an interesting observation. But it's just nice to see their revenue before we start to talk about what generates and drives revenue. We can see for Warehouse Club Inc., sales have been rising over the 3 years, mostly net sales with some membership fees. But what drives that revenue? And we're talking generally here now in the module. We're not specifically only looking at Warehouse Inc. As an analyst, you have to find the revenue drivers for the business you're considering. What are revenue drivers? They are causative factors, things that explain the level of and the changes in revenue. And as an analyst, you want to know what they are and how they're evolving over time. That's going to be based on historic evidence, but clearly you're using this to try and predict where they are going to evolve to in the future. 2 approaches to determining those revenue drivers, bottom up or top down, or a combination of the two. So really there are 3 approaches, if we're honest: bottom up, top down, or both. Bottom up, you look within the company at micro factors. What's driving their revenue? Primarily, it's the price they charge for the goods, the volume they shift, the product lines they're selling. So there may be a mix between premium lines and cheaper. Their geographic location, the split between where they sell, different tax regimes, customer bases, elasticities, and so on. This is really what we're going to look at for Warehouse Inc. here, because top down, the macro approach looks outside the company at the economy and says to try and work out what revenue is going to be, what's driving it. Let's look at GDP growth, the market size, within the market size, our position, and so on. That's the next reading. So we'll save that for the next module. Focusing instead here on a bottom-up approach, looking inside the company. What drives it? Well, prices. How can you set your prices? What constrains them? Well, the pricing power of the company. Do you have the ability to set prices and terms without affecting sales volume? That is the definition of pricing power. If you have pricing power, you are able, at least to a certain extent, to dictate to the customer what they should be paying and when they should be paying it. Now, just to think about Warehouse Club momentarily, do they have that power? Probably not. The retail industry is extremely competitive. Think of the membership fee. People pay the membership fee because they expect to get it back. And according to the management report, they can get it back 5-fold, but they expect to get it back via discounts on goods. If they increase the prices of their goods, people don't want to be members, and it's a members-only club. If you've got no members, you've got no club. Conversely, if they try to up the membership fee, they have to make sure that the prices they charge will still be attractive enough to tempt people to pay the fee. So in a competitive environment, it is difficult to obtain pricing power. It's a function of your market structure and your competitive positioning. In highly competitive markets, and this now should start sounding familiar if you've been through economics already, highly competitive markets have low barriers to entry, many available substitutes, very little differentiation in product, very low switching costs. Customers can just go where they choose. Warehouse Club are obviously trying to suck people in by getting them to be members, try and get a little bit of customer loyalty, make it difficult for them to switch. Well, classic examples, retail, well, that's where we're at. Oil and gas, fresh food, that's where we're at. Insurance, I don't think Warehouse Club are selling insurance just yet. Bank loans and deposits, you've got a huge range, a huge choice. And lots of markets, you don't just have a market that is competitive or is not. Over time, markets tend to become more competitive as innovation slows. You no longer have a market-leading good. Everybody catches up, and your goods become commoditized, making the market a lot more competitive. In that environment, firms are price takers. Again, this is economics. You've seen perfect competition in economics. You can sell as much as you want at the given market price. You increase your prices, people can go elsewhere. There's no sense in decreasing your prices because you can sell at the market price. And if you do, people will probably follow you. The downside, in the long run, your economic profit will be zero. Remember, that's economic profit, not accounting. So you're making a profit, but it is just enough to cover the required return of your investors. They don't make any excess profits. Or do they? It mentions in the module, if you're a low-cost producer and you can consistently maintain your cost below that of everybody else in the market, but sell at the same price, you could generate excess profits, an economic profit that is positive. But can you do that? Is that really possible? You have to stay as the low-cost producer in a competitive market. That's tough. Less competitive markets, high barriers help you out there, customer loyalty, high switching costs. So branded goods, when you have a reputation and a brand that people want, when you've got patents, obviously protects your position. That reduces competition. That gives you pricing power. Now you can, at least to a certain extent, choose the price that you're going to charge. Either using a value-based model. A value-based model tries to look inside the mind of the customer and say, what is this worth to you? Common in higher end luxury goods. Customers want it. They want to be seen with it. They want to be the one that owns it. That attaches value to the good in their mind, and you try and charge that value. Get them to pay what they think it's worth, rightly or wrongly. Cost-based, that's really just cost plus. You're really working on a margin there. This is what it cost me. I want to sell it at this to get this margin. Or price discrimination. You group your customers according to what they're willing to pay. Those that are willing to pay more, you get them to pay more. Those who are willing to pay less, you charge them less. Premium TV channels is a good example for that when you're looking at sport. If you want to show the Super Bowl in a pub, in a bar, a subscription to be able to show premium sporting events in a bar is about 50 times as expensive as it is to buy it domestically. So you're grouping your customers into commercial and domestic and charging different prices. And that's it. That's all we need to talk about in terms of revenue drivers. As promised, not that much to learn. It's just practice in thinking through a research report and what you'd want to put in there and what you want to look at. The reading or the module now just moves back to Warehouse Club and says, okay, let's do some bottom-up analysis. So let's look within the company, what drives their revenue. Well, there are clearly two sources, sales and membership fees. What drives sales? To a certain extent, I've got to think it's what they sell. Now, they did split. I don't think I brought this exhibit into this video, but they did give the split of fresh food, packaged food, non-food, and other. So we said volume would dictate it, and how much they sell of each one, and what's the pricing? Which of these four has a more attractive price? I'd also want to see some information on that branded line, because that branded line, I think the figure was 15% they banded about with for profitability on those branded goods. So I'd want to see the volume of branded versus these other lines, plus the add-ons. Do they sell or offer these pharmaceutical, optician services, the petrol stations, the gas stations outside? Do they offer those as loss leaders to get people into the store? Or are they drivers of revenue? Or do they bring people in? Do customers come in? Do we acquire customers because they want to get the cheap gas, the cheap petrol? Who knows? But if we take sales as a whole and say, look, we know they've got physical locations, it's all out of stores. So what drives their sales? It's going to be how much you sell in every store. Retailers will also look at a key metric, sales per square foot. We don't have that. So I don't want to compare this store to that store. If that one is twice as big, it's a meaningless comparison. So all I can do here with a little tiny bit of analysis is assume all these stores are the same size. Sales per store and the number of stores they have. If you can increase either of these drivers, you're increasing revenue. So if we have a look at the numbers from 2010 to 2019, time is now going this way, the opposite to their little management report extract. Let's just take from 2010 to 2019. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9 years of growth. Stores, 106 back in 2010, 147 in 2019. Increase of 39%. So certainly that driver will be increasing revenues. Net sales per store, 138 up to 193. Increase of 40%. So both of these drivers are carrying their weight. Increase of roughly 40% in each one. Your other source of revenue, membership fees. What drives that? Two very obvious elements. How many members are there? And what is the price of a membership? So we have, first of all, average members for the year. Let's use the average. Went from 5,900 to 10,017. That's gone up by pretty impressive 70%. Membership fee, $50 in 2010, $60 in 2019. I can do that math. 20%. So when we look at sales, I say, well, it's partly the number of stores and it's partly the sales per store. It's kind of equal between the two. They're both pulling their weight. When I look at membership fees, it is primarily the number of members they have. So I'm now even more interested in that question I didn't answer. How are they acquiring these members? One obvious answer, you're probably screaming at the screen. Well, Richie, they went from 106 stores to 147. That's going to be part of it. Yes, I agree. It probably is. And that's what this kind of exercise does. It just begs questions. More information I want. I now want to know not only how big are these stores and the sales per square foot, but also members per store. Are there some stores that have more members, some that have less? Are they all in the same sort of area? That might tell me a little bit more about the customer base. Okay, now we've looked at revenue. Let's move down the income statement and look at the cost side of their business model. We know what drives revenue. We know they don't have high pricing power. They're a discount model. So let's look at their operating costs, how they control those operating costs to stay profitable, and working capital using key measures. Working capital costs money. The great news, we know everything that's in this LOS from elsewhere in the curriculum. We know all of our working capital and all of our operating profitability measures from financial statement analysis. So this is just going to be review and application. So here we go. Operating costs. They generate and are related to current period revenue. This we know from the world of accounting. They are incurred in the acquisition, production, sale, improvement,